Good morning, everybody. Welcome to the quarterly economic outlook conference call. My name is Greg Sweeney. Today is Fed Day, March 19th, 2025. We expect the Federal Reserve to come out with their rate announcement later on this afternoon, but it brings up a good topic. Let's say we go right to addressing the elephant in the room, which is tariffs. Have been in the news quite a bit over the last month or so, so I thought this would be a good opportunity to try and tackle that right up front. Let's say for a second that we had the opportunity to have Chairman Powell right here in our offices, and we had one question for him: do tariffs increase the inflation rate? His answer to us would be, I don't know. You might find that surprising with all the information you've seen in the news about tariff increasing inflation rates, but the reality of it is, the reason why Chairman Powell does not know if tariffs will increase inflation is that he doesn't know how consumers are going to respond. What do I mean by that? The consumer, instead of continuing to buy the widgets that may be imported from outside the United States that now have a 20% tariff, just to make the math easy, for example, so the widget went from $1 to $1.20, he doesn't know if consumers will continue to buy that widget or if they would change their consumption habits and buy something else that may meet the same need that still only costs $1. So he doesn't know that, for example, if the consumer changes in needs, their buying patterns, excuse me. He also doesn't know if the full tariff will be absorbed by the consumer. Does the manufacturer absorb some of those increased costs that are imposed by the tariff? So there are various situations that could occur that do not affect inflation and do not affect the increase in prices that's so anticipated by so many of the news stories that you see today. I mentioned today was Fed Day. We do not expect the Federal Reserve to reduce interest rates today or increase them for that matter. We expect them to leave them unchanged. Right now, the lower bound is 4.25% and the upper bound being 4.5%. I would also add, since we're talking about tariffs and inflation, the sources of inflation right now that are reflecting about a 3% inflationary environment all come from the services sector. Other major categories, which are energy and food, there is virtually no inflation coming from any of those other sources other than services. And services are all generated within the U.S. here. So that's one of the reasons why you hear the news stories talking about tariffs increasing inflation, is because tariffs are going to be on those goods that are coming in from outside the country. And right now, those goods are not creating any inflationary influence based on how the inflation is calculated. GDP, right? The other thing you've heard in the news is gross domestic product is going to slow down because of these elevated tariffs that are being discussed. I would say that the prospect for slowing GDP is already written in ink even before the tariffs become a topic. And why do I say that? Over the past 4 or 5 years, in the wake of the pandemic, the government has taken on increased deficit spending at the rate of about 5 to 6% a year, which is about 2 to 3% higher than its normal deficit spending in expansionary economies. The government always deficit spends usually 2 to 3% when we're in a growing economy. And then when we go into a recession, the government deficit spends at the rate of about 5 to 6%. We've been deficit spending in the United States at a rate of 5.6% in that growing economy. That excess deficit spending above the normal deficit spending has added about $1.3 trillion to GDP, which is about a full percentage additional growth that wouldn't have been there without the deficit spending. The current administration is focused on reducing that deficit spending, and so it's almost written in ink that GDP will slow down about 1% or 100 basis points, regardless of what the tariffs do in terms of potential economic growth one way or the other. The current environment is leading to market volatility, not only market volatility, but even volatility in expectations for the Federal Reserve. We do not expect, as I mentioned, the Federal Reserve to raise the Fed funds rate or lower it today. Matter of fact, we don't expect them to change it in May either. And the overall market only right now has about a 73% probability of a 25 basis point rate cut in at the June meeting this year. We tend to look a little bit longer term than that. And as our indicator as to where the Federal Reserve might end up, there's a strong correlation between the Federal Reserve Fed funds rate and the 2-year Treasury. And right now, the 2-year Treasury is at about 4, just a little bit above 4%, about 4.07%. And what that is telling us is the 2-year Treasury market, which is fairly accurate in terms of a consistent long-term relationship, suggests that the Fed is only going to reduce interest rates about 1% or at one move this year down to 4%. In our particular perspective, we think the current Fed funds rate is neutral. In other words, given the underlying inflation rate and given where the Federal Reserve is, we see that as neutral. So we're consistent, I guess, with what we see in the 2-year Treasury that we think maybe only one cut this year from where we sit right now. It would be very difficult to be the Federal Reserve in this environment. Why do I say that? The Federal Reserve has two responsibilities. One, stable prices, and right now we're talking about prices potentially being unstable. And their other responsibility is full employment. Is that the economy employs as many people as it possibly can. Those are their two responsibilities. If the tariffs do end up in increased inflation, right, they would have a tendency to raise the federal fund rate to slow down the price increases. If the economy and GDP slows down, they're going to want to decrease the Fed fund rate to stimulate demand and help gross domestic product grow. Well, tariffs could be, as we've mentioned, both put rising pressure on prices and slowing pressure on GDP. That environment, we haven't heard many people talk about it, but that environment is what's classified as stagflation, rising prices, slowing economic growth. So you could hear that term start to come up if we see that situation I just mentioned, rising inflation and slowing GDP. Real quick, back to markets and volatility right now. Not only is there volatility in the expectations for Fed rate cuts moving forward, but the volatility is extending to the market as well. Is that volatility due to current topics on tariffs and cutting excess deficit spending? I don't know for sure. Longtime readers of our economic outlooks have heard us talking about elevated valuations for quite some time. AI has been a significant theme in the markets. We haven't heard much about AI lately, right? The market's favorite, NVIDIA, is off of its highs. We are seeing market pressure. The S&P 500 this year is off about 6% as I'm doing this video again, March 19th. Year to date, today so far, at least prior to the Fed meeting, the markets are responding pretty favorably. At the same time, the Magnificent Seven, remember that topic from last year and the year before? It's the 7 largest companies in the S&P 500. They made up about a third of the overall S&P 500, even though there were only 7 companies out of the 500. And what we were seeing now, year to date, is that Magnificent Seven is not so magnificent anymore. Those are off about 16% year to date. So the situation that we were talking about, the excess weighting over the last almost a year now, has significant weighting, has come back up to the surface, but only as a negative influence instead of a positive influence like we've seen over the last about 18 months. So long-term investors, do you need to be concerned? No. Volatility is part of this process along the way. The market's kind of is become accustomed to looking for what we call the Fed put. If the market gets soft, they look for the Federal Reserve to reduce Fed funds rates like we're talking about, or they look for the Fed funds to do quantitative easing, which is purchases of security in the open market. We don't expect any of that to happen. We don't think the Fed put is an option for the market anymore. So we're seeing this market volatility manifest itself quite a bit more than we've seen over the recent past 24 months or so. Even though the markets are volatile, we still look at them as being orderly. We are not seeing any change in the flow of market offerings, in terms of new debt issues or new equity issues. We're not seeing any stress in the riskiest parts of the market. So far, we would call this volatility orderly and normal. And this is not a situation where long-term investors need to worry. If you're just started saving for your own retirement or putting money aside, situations like this tend to be good buying opportunities. So there are advantages in in a volatile market environment. So anyway, long term, we don't expect this to be an issue. We've seen it many times before. We expect things to normalize in a period of time. It's not going to be immediate. If you looked at our 2025 economic outlook call, we're looking for more volatility than we've seen over the last couple of years. That's manifesting itself right now. We're looking for markets to gravitate back towards the mean. We've seen equity returns in excess of its long-term average. Long-term average equity market or stock market returns about 9.5%. We've seen the last 5 years be 13% or so. Something normally happens to make those gravitate back towards the means. This might be the first step in that direction. So my message is, don't panic. This is a normal, orderly market volatility, if we can call it that, but stay focused on the long term and your ultimate market or investment goals. Thanks, everybody. Looking forward to seeing you in the next quarterly update conference call in a couple months. Bye now.